Is this the beginning of the end of elevated interest rates? The Federal Reserve met last week and held rates steady for the sixth consecutive meeting. Let's discuss what was said and how the market reacted and what we can look forward to in this week's Mortgage Market Update. I think it's unlikely that the next policy rate move will be a hike. That was Fed Chair Jerome Powell just this last Wednesday as the highly anticipated Fed meeting took place. With inflation potentially reaccelerating, there were growing fears that the Fed might have to hike rates again. So this was indeed good news, supporting the hope that their next move will be a rate cut. However, while the Fed said a rate hike is not likely, he also shared that a rate cut is not likely to happen in the near term either. Quote, in recent months, there has been a lack of further progress toward the committee's 2% inflation objective, according to their policy statement. Until the Fed sees inflation move sustainably toward 2%, we should not expect a rate cut in the near term. The bond market, however, was okay with this and rates did improve. So why would rates improve if the Fed signaled no cuts just yet? That's because the markets see the Fed is serious about bringing inflation back down to its goal of 2%. This is good for protecting the value of long-term bonds like mortgages as inflation erodes its value. If inflation continues to moderate, it will help long-term rates moderate as well. The markets also embraced another policy statement from the meeting, quote, beginning in June, the committee will slow the pace of decline of its securities holdings by reducing the monthly redemption cap on Treasury securities from $60 billion to $25 billion. This slower pace of supply of bonds coming into the market will help put downward pressure on interest rates. Possibly having a bigger impact on rates than the Fed was the Treasury's announcement that they will not need to sell many more bonds in the second quarter to help fund the government. This was good news for bonds and rates. Now, why is that? Well, bonds hate more bonds. When the Treasury must sell more and more bonds to fund the government, it puts downward pressure on prices and upward pressure on yields. 4.7% as we start the week. The 10-year Treasury note is hovering around 4.5%, which is now nicely below the 4.7% level that has served as a ceiling preventing yields from moving higher. Seeing the 10-year remain beneath this ceiling after the Fed meeting is a good sign and could start signaling a peak in rates for 2024 and perhaps the beginning of the end of elevated interest rates. We shall see. Now on the jobs front, on Friday, the Bureau of Labor Statistics, or BLS, reported that there were 175,000 jobs created in April, which was well below the 243,000 expected, and the previous 2 months were revised lower by 22,000, adding to the miss. The unemployment rate moved higher from 3.8% to 3.9%, and this matches the unemployment rate we saw back in February, which was the highest figure since January of 2022. If you look at the U6, which is a broader measure of unemployment within the BLS report, which does not remove people from the labor force, the unemployment rate increased from 7.3% to 7.4%. This is the highest U6 reading since November of 2021. This softness in labor may be an initial indicator that the higher rate environment is starting to take its toll, which will be supportive of an eventual Fed cut. Bottom line, interest rates are trying to find a peak, and getting past the Fed, the Treasury announcement, and the jobs report this last week was a nice hurdle as we move deeper into spring. While I don't expect much more of an uptick in rates, I also do not expect a rapid improvement either. Now looking ahead, this week the Treasury Department will be selling a lot of debt. It will be interesting to see what the buying appetite at the bond auctions will be now that the Fed has calmed the markets a bit as they begin slowing the balance sheet reduction come this June. There will also be a lot of Fed speakers hitting the pavement and sharing their thoughts. Will they signal the end of higher rates is indeed in sight? We shall see. As we wrap things up here, here's a peek at current mortgage rates to start the week. Feel free to hit the pause button for the details. And as always, thanks for hanging with me for this week's Mortgage Market Update. Be sure to like, comment, and share. And if you need personalized mortgage advice, I am always here to help. Reach out to me today, and I look forward to funding your future. Have a great week.